In the trading update, Absa said it expects both annual headline earnings per share and diluted headline earnings per share to be between 18 and 20% higher. And another news out, Deputy CEO of Absa, Louis van Zierner, will step down next year. Van Zierner becomes a non-executive director. This is the latest senior manager reshuffle at the Barclays-controlled lender in the recent weeks. So on that note, gentlemen, I welcome you to Hot Stoxx. Thank you so very much for joining us. Jonathan, let's start off with you and with regards to Louis van Zierner stepping down. And moving into that non-executive director role, how important is this with regards to the overall operations of the company?
Well, I mean, it's not only Louis. We've had 4 executives now from Absa that are stepping down. But I'm not that worried about Louis. He's stepping down officially next year, January, and then he's on the call he talked about spending 60% of his time on Absa-related matters. So it's not really a stepping down. I think he's more just taking a little bit more time out, and he's certainly, I see the headlines today say King Louis resigned. So, I mean, he hasn't really resigned. He's just stepping
well, it's interesting.
down.
I mean, he's making a move for some reason. So it'll be interesting to see how that plays out. So, Craig, let's get a sense from you. I mean, as Jonathan mentioned, 4 executives actually leaving. This is a deputy CEO that we're talking of.
Yeah, no, look, I mean, it's probably significant because he's been there for 3 decades. But his focus has been really largely on retail banking. That's where his experience is. Bear in mind, that's about 40% of the Absa group at the moment. Over the years, the group's changed, especially with Barclays coming in. And I suppose sitting with in excess of 20 people around a boardroom table, it's difficult to make decisions. So maybe streamlining the board, having a good balance between executive and non-executive is not such a bad thing, and it sort of complies with what King's looking for too.
Yeah. So let's quickly touch on the headline earnings per share number that is expected to come through from Absa. 23% higher, as much as 20% higher, in fact, actually 20% higher. What is your sense with regards to that number? It seems that it's great. It's in double digits, but it is off a very low base, Jonathan.
Yeah, it's very low base. I mean, it's a smidgen, maybe a % higher than what I thought it would do. So it's bang in line. And I was looking at consensus numbers. Consensus is pretty close to that. Yeah. I mean, we're seeing that with all the banks now, they will come through with pretty good earnings because bad debts are reducing what they have been compared to what they've been historically. So we're seeing that improvement in the bank's earnings.
And the truth of the matter is that Absa has only been up around 5% or so since the beginning of the year. We know that there has been a little bit of a focus that has come through in the banking stocks. Do you think that Absa is going to be one of those favourites this year, Jonathan?
I mean, all the banks have moved up a little bit. I prefer a Standard Bank to an Absa bank. So I don't think Absa is going to be an absolute darling. It doesn't seem particularly cheap to me at this point in the cycle. But I mean, it'll give you, my sense, it'll probably give you between a 10 and 12% return over the next 5 years per year.
Craig, 20% higher on the headline earnings per share number. That is as much as it can actually go up. And the truth is that when we see what happens on the retail side of things, we're seeing profits increasing there, better impairments also coming through. I suppose the big question has been is how long they can actually sustain this, or if we see a bit of a retracement because of a deterioration in the economic environment.
Yeah, I think if you look at the reaction from the share price, I think the market largely expected it. The first half earnings was 19.1%. Bear in mind, 2010 you saw negative HEPS, so it's come off that low base, and it's in line with what other banking shares are putting out. In fact, Absa has been a bit of a laggard in terms of the performance. I think I'd be correct in saying First Rand is pushing close to 20%, Nedbank around those performance over the last 12 months too, whereas Absa has been pretty flat. Investec's probably the only other exception that's also underperformed. Yeah. So yeah, the sustainability is probably largely going to depend on margins on their lending. And obviously the transactional banking is going to come under pressure. And we can see they've introduced a new product called Transact. I think it's a story that's going to roll out with a lot of the banking stocks, is that they're going to have to look at transactional costs.
And that's because competition is actually heating up, Craig, in the space.
This year there'll be
competition is heating up extensively in the space. Competition.
Yeah, well, absolutely. With Capitec coming on board, to a large, probably led a lot of the competition, but yeah, they've had to imitate or die, really.
When it comes to the competitive environment, I mean, it's it's a very positive scenario that is playing out because it is going to make the banks more efficient and far more lean. But costs in the previous period, you know, they were up around 8%. Staffing was also up quite extensively. Do you think we're going to see a tapering out in this?
Well, I mean, the thing for me with Absa and with all the banks really, Absa's balance sheet has been static. It hasn't really, if you look at its total assets, hasn't gone anywhere. In fact, it's declined over the last 3 years. So for me, I want to see all the banks, I want to see them starting to lend. They've been consolidating. I understand there was a difficult time, but now they need to start lending. For me, the next move, the next growth in their earnings isn't going to be coming from containing costs. They need to lend more.
Okay, but that's also with regards to the lending, well, the risk profile of a lot of the consumers. We have very strict regulations intact, the NCA as well. We've got very low interest rates, so hopefully we are going to start seeing a bit of oil in the machine.
Yeah, well, that's the thing. I mean, the economy needs more lending. I mean, you're also seeing it on a lot of the banks are kind of following a Capitec and an African bank. They're trying to go into the lower LSMs and giving unsecured finance. Now, I'm a little bit worried about that. Personally, I'm a little worried about what African banks are doing. But I mean, all the big banks are now following quite aggressively into that. I know African banks have been commenting on that, saying that, look, listen, you know, we used to play on our own in the space, and now everybody's coming to play.
Okay, so Craig, do you think that it is wise that Absa then gets into the lower LSM level and this unsecured lending space? When we saw the private sector credit extension numbers and the overall money supply numbers as well, that data actually revealed that unsecured lending is growing 30% year on year. So we've seen quite a significant increase there.
Yeah, there seems to be a lack of credit demand in the higher LSM market, and as you say, the NCA and everything else has perhaps made it a little bit more difficult to get credit. But that unsecured lending market is where the action's been. We've seen that in terms of consumer reaction and the money that seems to have flowed into the system. So I think all banks need to look at operating in that. We can see how successful the likes of a Capitec has been. So this is what Absa is now focusing on. But bearing in mind again, retail is a smaller portion of their total model. So business banking is still a very important part, as is Absa Capital and putting deals together. So that non-interest revenue is quite important to the group.
Craig, what about cost to income? Previous number we saw very close to 55%, sitting at around 54.8 versus the 53.6 in the previous period. Is this a worrying number for you?
Yeah, look, I think the group, Barclays, is certainly going to put more pressure on them to get that cost to income figures a lot better. But what's good is the return on equity hasn't been too bad. It was shy of 16% last year. It's certainly going north of 17, perhaps heading towards 18%. So it's good to see good return on equity, and if they can get those costs under control, that'll be a good thing. I mean, we're in an environment now where they've come from the negative endowment effect. It's difficult to predict interest rates as we sit right now, but it certainly appears to be the bottom of the cycle if you consider inflation. And so perhaps going into an endowment effect will be good for banks in general. And Absa will certainly be one that will benefit.
Jonathan, hot or not for you, Absa?
It's not cheap. 1.7 times book. A 17-16% ROE. I think ROEs could rise to maybe 18-19%, 4% dividend yield. It's not hot for me. I think there are other banking stocks which are cheaper.
So tell me which banking stocks you like.
I prefer Standard Bank over an Absa at this point.
Craig, hot or not, Absa?
I'd put a hold on Absa. If you've got it, sit with it because it's underperformed the other banking stocks and is likely to play a bit of catch up. If I was to be buying something, probably Investec would be my preferred choice.
Right, there you have it. So let's delve into the next stock. In a trading statement, Italtile, the ceramic tiles supplier, expects interim headline earnings per share to be between 20 and 23% higher. The group noted that while conditions were challenging, it managed to increase turnover of group-owned stores by between 20 and 25%. The group's results are due out on the 15th of February. Jonathan, Italtile, great set of numbers that we can expect going forward. But of course, we also know that it has its own set of troubles during the recession and during the troubled times in South Africa, and seems to just become very efficient through the last couple of years.
Well, I mean, we've heard it from a couple of players that Italtile, they are taking market share. There are a number of smaller players which are quite weak and they're struggling. And a lot of them, they import their tiles. Now, with the rand having moved 15-20%, it makes it a lot more difficult for those guys to compete. So Italtile's been taking market share. It's an incredibly well-run company. I know they had a terrible incident last year in February where they lost the CEO, but I mean it's carrying on going, and it's doing well, and we can see the numbers.
And they sell across all LSM levels as well, with various brands. So this putting them in quite a strong position, would you say?
Yeah, no, well, it is. I mean, they've got Italtile, they've got TTM, and then they've got Top T, which is aiming more at the low end of the market. But yeah, it's well run.
Craig, what is your sense on Italtile? I mean, very strong balance sheet as well. And as I mentioned, just some of the interesting points with regards to the various brands that they have, they actually cater for a wide variety of people.
Yeah, look, strong balance sheet, good cash flow. And I think it's the right stage in the cycle. If you look at the likes of Build It and the Spar Group and Mass Build and the Massmart Group, these are the companies or the parts of the groups that have actually done very well. So hardware is a good story. I think people have been spending more on looking after the home and maintenance as opposed to going and buying new properties. So that Build, it certainly will benefit the likes of Italtile. And even at the end of construction cycle, the likes of Italtile will benefit. And they've done some good things. I mean, CTM's pricing is known to be pretty good in the market. They've made the experience, the customer experience, a lot better with investing in point-of-sale handheld devices to make the process a lot quicker. So they're thinking a little bit differently, and you want to start obviously seeing that now in the figures.
And they're also just saying that across the whole group, it seems that all stores actually performed well from what they're telling us. And they've got 14 stores outside of South Africa, 106 total stores, and 8 stores in Australia as well. So they're not a pure South African play. Craig, for you. Yeah.
Look, Australia. There's been adverse trading conditions there, so that's been a bit of a disaster. I think most that have had a foray into Australia found that market very difficult, and obviously there's pressure there. Now they can't get their buying right and move at the right price in Australia. But the rest of Africa is a good story. I think there's about 14 CTM branches, and then you've got that Top T, which is really designed around rolling out onto the African continent. And I think if they continue with that strategy, it'll work well for them, because there's certainly a lot of development in Africa. And so we've seen that with Cash Build moving out into Africa. I think the story could play out quite nicely.
Okay, are you as optimistic?
I think it's well run, and I think they will be successful in Africa. I'm optimistic, yes, for the business, but at the current share price, I'm less. Are you
already giving me an answer?
I'm giving you an answer.
Also owns a property portfolio of around 1.3 billion rand.
Yeah, the property is probably actually undervalued slightly on the balance sheet. I mean, that's another value underpin. They own, I think it's 95% of all their stalls. So that is another good foundation. You're not going to lose all your money.
And also a very strong dividend payer.
Well, 2.5%. Yeah. I think the current dividend yield is, I mean, there are much better dividend yielding stocks.
I mean, it's sitting on a strong pile of cash as well,
sure.
So interesting to see if they've drawn that down in the next set of results.
Well, yeah. Well, let's hope we get some of it as investors.
Absolutely. So, Craig, hot or not for you?
Yeah, just to emphasize that property, it's about 30% of the share price. So 1.50 is represented in the property, probably undervalued. 3.50 is what you're paying for the business. Forward PE of 12. I think it's worth looking at. It's certainly cheaper than the Cash Build and so on, so I'd say hot.
Hot for you. Okay, so what is your...
so there's no problem buying it. I personally wouldn't rush out and buy it, but I have no problem recommending it as a buy.
So not the same view that you share with Craig?
Yeah, I mean, look, it's trading at 2.7 times book. I mean, if you look at it historically, I think it's traded at 3 times. So maybe there's a little bit there, and it'll earn on it, if you project forward its current earnings, it'll earn about 12.
So what would you like to see change for you to actually head in and buy the stock?
I'd like to see a cheaper share price.
Much cheaper. So a PE of 12 doesn't...
Well, I mean, there are other opportunities out there.